Hi, I'm Jamie and I'm a new marketing assistant here at Ridgefield Consulting, and I've just started here as part of my college placement. So when I joined, I didn't really know a lot about accounting, so one of the first things I wanted to know was how much tax you actually need to pay. So as someone who's just started paying tax recently from their salary, I wanted to make sure that I'm not paying too much or too little. So in this video, I'm going to explain about pay-as-you-earn tax, or PAYE as it might say on your payslip. Most people employed may not think about how much tax they actually pay because it gets deducted automatically. This means everything you receive at the end of the week or month has had the tax already taken out of it. Although your tax has been calculated for you, it's still important to know what your payslip means so you can make sure no mistakes are being made. One of the most important things to look out for on your payslip is your tax code. It's usually 4 numbers followed by a letter. The number indicates your personal allowance, which is the amount you're allowed to earn before being taxed, and the letter means different things. L is one of the most common tax codes. It simply means you're entitled to standard personal allowance for that tax year. I'll explain more about this later. If you have more than one job or pension, you're likely to see different letters. BR is short for basic rate, and the earnings from this job or pension will be taxed at a basic rate, which at the time of filming is 20%. DO means higher rate. You need to pay a higher rate tax on income over £50,000 but below £150,000. This rate is 40%. D1 means additional rate, and this applies to anyone earning over £150,000. A rate of 45% is charged on all income over this amount. If you see the letter S, it means your income or pension has been taxed using rates in Scotland. If you see the letter C, it's been taxed for Wales. There are lots of different codes, so if you see a different one on your payslip, don't worry. If you go to the government's website, you can find out what it means. It's a common misconception that you pay tax on everything that you earn. At the time of filming this in February 2020, you can earn up to £12,500 without paying any tax at all. This is known as your personal allowance. You only start paying tax on anything that you earn over that amount. However, you will also start losing £1 of your personal allowance for every £2 of income once you start earning over £100,000. So to calculate how much you'll be taxed, you need to start with your personal allowance, which we know is £12,500, which you can earn tax-free. If we use an example of £30,000 for the annual salary, you can take off £12,500, which is your personal tax allowance, which will then leave you with £17,500. As this amount is under £50,000, you'll only be taxed at the 20% basic rate. 20% of £17,500 is £3,500, so this is the right amount of tax you should be paying on an annual salary of £30,000. If your earnings fall into the higher tax bracket, say £55,000 per year, you would pay 20% on your earnings between £12,501 and £50,000. This means that £37,500 will be taxed at 20%, which is £7,500 to be paid in tax. The additional £5,000 from your £50,000 annual salary will be taxed at 40%, which equates to £2,000. Meaning you'd need to pay a total of £9,500 tax on your salary of £55,000. As well as income tax, on your payslip you'll notice that national insurance has been deducted. You pay national insurance contributions to qualify for certain benefits, such as the state pension or maternity allowance. You'll receive your national insurance number when you're 16, and once you have it, you'll start paying if you're earning more than £166 a week or £719 per month. Just like tax, you pay different amounts based on how much you're earning. If you make £118 to £165 per week, you'll pay 0% of your earnings, but you'll still qualify for benefits like the state pension. If you make £166 to £961 per week, you'll pay 12% of your earnings, and anything earned over £962 per week, you'll be deducted at 2%. One of the main benefits of these contributions is that it will help you qualify for the state pension once you reach retirement age. To be entitled to receive the maximum amount, You need to have contributed for 35 years. At the moment, for 2020, the state pension age is 66 for both men and women. Another deduction you may see on your payslip is your workplace pension. This is automatically deducted for people aged 22 or over and earning over £10,000 from a single job. Although you can opt out at any time, by staying enrolled you're essentially getting free money from both your employer and the government. You pay 5% into the scheme, with your employer paying 3% into the scheme and the government paying 1% through tax relief. You can then access this money when you're aged 55 or over, and unlike tax and national insurance, you can opt out of this by asking your employer. There are also some other deductions which may appear on your payslip. Court orders. If you have a court order, your employer may be asked to take money directly out of your pay. This can be used to pay fines or child maintenance. Workplace benefit repayment. Some employers offer loans like rail tickets, and they'll usually take payments directly out of your payslip. And finally, charity donations. You can choose to directly donate to a charity straight from your paycheck. So I hope that's helped clear up any confusion about what your payslip is. If you have any further questions, it's best to ask whoever runs your company payroll, because they'll know the most about your certain situation and will be able to help you the most. No company wants to underpay their staff, so they'll be more than happy to help. Thanks for watching, see you in the next video.